The silver market is under unprecedented stress. Industrial buyers are panicking as banks hoard physical metal at record levels. The retail public barely notices because screens show normal prices and statements appear routine. But the reality is different. Banks are securing physical silver to comply with Basel III and NSFR regulations. Paper contracts no longer satisfy regulatory requirements. Every unallocated account is now a liability. Industrial companies, from tech giants to manufacturers, are scrambling to secure supplies before the banks buy all available inventory. This is not speculation. It is forced action. Banks must strengthen their balance sheets with tangible assets. Physical silver is now a Tier 1 asset. Compliance dictates purchases. The effect is immediate. Prices spike in smaller markets, premiums rise, and supply shortages appear. Traders notice unusual demand patterns, while retail investors remain unaware. Banks act quietly, acquiring ounces directly from refineries and wholesalers. Industrial buyers face delays and higher costs. Statements and real-time data screens provide false comfort. The underlying mechanics are invisible to most. The hoarding creates a cascade of scarcity. Industrial supply chains feel the strain. Tech manufacturers, automotive companies, and electronics producers compete with banks for the same physical metal. Delivery times lengthen. Costs escalate. The retail market for coins and small bars tightens. Paper contracts are increasingly irrelevant. Banks prioritize compliance and ownership. Industrial buyers who delay action risk being priced out entirely. The system has shifted. Every ounce acquired by banks reduces availability for the next buyer. Forward contracts no longer guarantee delivery. Unallocated holdings are insufficient. Access risk is real. Physical possession now defines security. The hoarding triggers secondary effects. Hedge funds betting against silver face margin pressure. Short positions are squeezed. Banks lend less in dollars to support metal purchases. Liquidity tightens. Exchange rates react to metal demand. Volatility rises in FX and futures markets. Industrial buyers must compete with institutional accumulation. Timing becomes everything. Those who act early secure supply at better prices. Those who wait face inflated premiums and delayed delivery. The mechanics are deliberate and regulatory driven. This is not panic. It is mechanical necessity. Basel III rules force tangible asset accumulation. Banks act first. Industrial buyers follow. Retail investors are last. The hierarchy determines who gains and who loses. Access risk grows as unallocated accounts become liabilities. Banks acquire directly from refineries. Inventory drains rapidly. Every purchase accelerates scarcity. Prices rise faster than anticipated. Market sentiment lags behind reality. Physical shortages precede price spikes. Retail access is limited. Awareness is critical. Those holding physical silver gain stability. Those relying on paper or digital claims face exposure. Statements mislead. Screens mislead. Only possession guarantees control. The industrial squeeze intensifies. Factories scramble to secure stock. Banks hoard aggressively. Delivery schedules slip. Cost inflation spreads across supply chains. Short-term volatility masks long-term scarcity. Regulatory compliance drives purchases. Every ounce bought removes supply from the open market. Industrial buyers compete with institutional accumulation. Market signals lag behind. The alert is active. Every unallocated account now carries risk. Banks act first, securing their physical requirements. Industrial users react second. Retail investors observe last. Timing defines advantage. Physical possession is critical. Paper holdings are exposed. Supply chains strain under regulatory-induced hoarding. Prices adjust upward. Scarcity becomes obvious to those watching delivery times. Hedge funds adjust positions. Short covering occurs. Liquidity tightens. Physical metal is the anchor of safety. Timing, access, and awareness determine advantage. Those who understand can position early. Those who do not may face limited access and high premiums. Compliance drives institutional behavior. Market mechanics follow. Retail participants face delays and rising costs. Every bank purchase accelerates scarcity. The industrial panic intensifies. Statements remain calm, but inventories shrink. Delivery gaps widen. Those relying on paper contracts are exposed. Awareness is essential. Physical possession guarantees stability. Paper claims are secondary. The system enforces a hierarchy. Banks first, industrial buyers second, retail last. Timing is critical. Prices rise, access tightens. The physical market dominates. Alerts are active. The industrial silver shortage is real. The market is adjusting to compliance-driven accumulation. Those who act now secure supply and protect value. Those who wait face scarcity, higher costs, and delayed delivery. Awareness, timing, and physical possession define advantage. The silver shortage is not temporary. It is systemic, regulatory-driven, and active. Compliance forces action, banks hoard. Industrial buyers panic. Retail access is limited. Prices reflect scarcity. The alert is live. The hierarchy is enforced. Physical possession is security. Paper contracts are vulnerable. Timing and preparation determine who benefits. The silver shortage is active. The market mechanics are unfolding now. Compliance drives accumulation. Access risk grows. Awareness is essential. Physical metal ensures security. Paper reliance risks exposure. The system is acting. The alert is real. Industrial panic is underway. Banks hoard, supply tightens, prices rise. Timing defines advantage. Physical possession guarantees control. Paper claims cannot replace it. The shift is active. The alert is immediate.